In this video, I'm going to show you 7 completely legitimate business expenses you can't deduct. Coming up next on Holy Schmidt.
Holy Schmidt!
Hi, this is Jeff Schmidt with Deductions.tax and welcome to another video. Hey, if you want to learn how to grow your business, cut your taxes, and other entrepreneurial related actions, make sure you hit subscribe below and click notifications so that you get notified the next time I post a video. IRS code is confusing, filled with favorable exceptions for property owners, hedge fund managers, and others that make a CPA's job very challenging. On the other end of the spectrum are business expenses that generate revenue, but the business owners can't deduct those expenses. In the next few minutes, we're going to cover 7 perfectly legitimate, ordinary, revenue-generating expenses that business owners can't deduct because of the IRS tax code. Number 1 is clothing for work, completely non-deductible except for uniforms. If I was in the pest extermination business and I showed up for work in a forest green golf shirt, a pair of khaki slacks, and brown walking shoes, that outfit would be considered a uniform and would be completely deductible. That is, assuming everybody else in the company wore the exact same outfit that I wore. However, as an accountant, if I showed up to work in a blue suit, white shirt, black tie, and black polished shoes, I could not deduct the cost of that outfit. Theoretically, the difference is the dual use of the uniform. But if you've watched Cheers, you know that Cliff routinely showed up at the bar wearing his postal worker outfit behind the bar stool. Conversely, most accountants don't show up at the Sunday barbecue wearing a suit and tie. Number 2 is research costs to start a new business, completely not deductible. Let's say I had an entrepreneurial spirit and a few $1,000,000 and I wanted to get into the oil exploration business. But I want to make sure that the business is profitable before I commit many years of my life to this endeavor. I spent $100,000 of my money and 3 months of my life with consultants and lawyers to get a deep immersion in the oil game, and I make the decision that this is something I want to do. I then start Jeff Schmidt Oil Exploration LLC. That $100,000 upfront expense is completely non-tax deductible. Now let's take it one step further and say I spend another $100,000, hire the same consultants and the same attorneys to find land for me that I purchased for $100,000. And subsequently I find out that there's no oil on that land, so it is a complete and total loss. That second $100,000 expense is completely deductible because the business is up and running. Number 3 is hobby losses. Now this one really bothers me because it's not the business owner that calls the business a hobby, it's the tax man. If you engage in business without the intent of making profit, you must report all revenue from that business to the IRS, but you can't deduct any of the expenses related to that revenue. Now let me see if I've got this straight. I set up Jeff Schmidt Coin Collectors because I like to collect coins, which I do, by the way, buying and selling them but not trying too hard to make money. Then one year I find an 1896 S Morgan silver dollar listed for $200 at an estate sale, but its true value is $18,000. I of course buy it. I sell it 6 months later and realize the $18,000 in value, and that year I spent $2,200 traveling around the country buying and selling coins and looking for something like the Morgan. That $2,200 in travel expenses is absolutely not deductible, but I still have to report the $18,000 that I made on the coin, less the $200 acquisition fee for the coin. Speaking of expenses that rhyme with hobby expenses, the next one is called lobby expenses. Basically spending money to influence legislation. Let me give you an example. It's December 1999 and there's a lobby group called Save Ben & Jerry's. The group is put in place to stop Ben & Jerry's from being bought by any international food company. At the time, the governor of Vermont, Howard Dean, and Congressman Bernie Sanders were all part of the push to save Ben & Jerry's. Now, if you were a powerful dairy farmer in Vermont and you had thousands of acres of dairy farming land, you may contribute $1 million to that lobby to stop that from happening. Why? Because you want all milk production that goes into Ben & Jerry's ice cream to be purchased either by you or your friends in the dairy business. Now here's the interesting part. If you had contributed $1 million to the lobby, that $1 million would be completely non-deductible. But if you had taken out $1 million of ads saying buy local and ran those ads throughout Vermont, even giving you the same effect, those ads would be completely deductible. By the way, before I forget, if you like the video, please click like below so that other people can find it here on YouTube as well. Number 5 is a parking ticket on a car while out on company business. Now this is a funny one. If you were to say, Jeff, fines and penalties should not be deductible, that would be a hard one to argue against if the tax law was consistent. But if you have a business credit card and you're late making your payment and the credit card company charges you a $25 late fee, that $25 late fee is completely deductible. But if your meter runs out before you get back to your car and you have a $25 ticket, that is completely non-deductible. Number 6 is life insurance taken out on a key person in your company. I have to admit, this one seems counterintuitive because if an officer of the company gets hit by a bus, literally, and it causes economic hardship to the company, then you should be able to insure that. Unfortunately, if the recipient of the life insurance policy is the company, that life insurance payment is non-deductible. It is worth pointing out that property and casualty insurance on the company headquarters, on company cars, on business machines within the company are all deductible. The premiums on that insurance are completely tax deductible. Why it doesn't apply to key person insurance? I don't know. Number 7 is volunteer hours. If you're a socially minded employer and you allow your employees to contribute 2 or 3 volunteer days per year, the economic loss of not having those employees while still paying them is not deductible. Let me get specific. If you had an employee that made $50,000 a year, that's $25 per hour if they work a 2,000-hour work year. And if they're gone for 2 volunteer days, that's a total of $400 for the 2 days. That's $400 of production that employee can't deliver to the company over those 2 days. The IRS will not allow you to claim that $400 on your tax return. If, however, you had made a $400 donation to the same charity, that $400 would very likely be a full tax deduction for you on your business tax return. Now those are my 7. Do you have examples of other expenses that you think should be deductible but aren't? Put them in the comment section below. And also, as I said before, don't forget to click subscribe below and click notifications if you want to be alerted the next time I publish a video. I publish about twice a week. Finally, before you go, check out this video right here on 10 business expenses that many, maybe even most entrepreneurs miss. This is Jeff Schmidt. Thanks for watching.